And I guess we'll go ahead and just launch right in. As Larry always likes to keep the train running on time, right? So in his honor, as he will not be joining us today, he is taking some well-deserved time off. So he is not going to be on the call. So lucky you, I get to take over the rep call yet again. You guys are in for a real treat today, because if you checked out the rep call notes, you will see that the first item for discussion is one of our favorites. In fact, if you were on the last call that we had, you may remember that I said, I'm going to beat this dead horse a little bit more, right? And what dead horse would that be? That's sending emails with PII, that would be personally identifiable information, encrypted. You'll be pleased to know that we had a couple incidents pop up recently. And so at Larry's direction, and yes, I will gladly throw him right under that bus, he has asked me to cover this topic in a little more depth on this call, even though I did mention it briefly on our last call, and I have mentioned it ad nauseum on previous calls. So yes, Larry, he told me to do it, although full and fair disclosure, guys, I am only too happy to comply. This is one of my favorite subjects to discuss, because I still, to this day, every single day I'm in Smarsh email review, find emails, and I am not exaggerating, guys. At least once a day, and that's a good day. At least once a day, I will encounter an email in Smarsh Review that is non-compliant due to sending PII unencrypted. So this is your fault. It's your fault. You're going to have to glaze over and listen to this again, but I am only too happy to cover it. All right. So what I think I'll start with is the rep call recording from the last time that I discovered this in a lot of depth, and that would be back in October of last year. I wanted to cover briefly what is PII, because there's a lot of reasons maybe that you might send it out unencrypted. One might be just that you forgot, but another one that I encounter sometimes is that maybe you're sending something you just did not realize was considered PII. So I do want to cover a little bit of the common examples, right, that you would be sending that would be considered and fall under that umbrella of personally identifiable information. Pretty obvious ones here at the top, right? Social security number is pretty clear, I am sure, in most of our minds, that is PII. Definitely don't send that unencrypted. But it can also cover things such as date or even place of birth. That was a new one for me when I covered it in October. I did not know that. Seems kind of innocuous, but hey, they throw it in there. So I just, I don't make the rules. I just, force you guys to follow them. Driver's license numbers, mother's maiden name, the medical history information. And for those of you who do a lot of life insurance, perhaps you might encounter this a little bit more when you're sending information regarding something that could cause maybe a table rating. So you're discussing some medical history of the client. That would be something that might apply to you. Criminal history, employment history, or other even current employee or employment rather details. Financial information, obviously this is one you guys are going to see a lot of, right? And that could cover anything from actual account numbers, not just bank account, but brokerage account. That would count as well. Credit card numbers, statements, any of that information, financial information is PII. That's going to be one that you guys are going to be dealing with clearly a lot. Then biometric record associated with an individual, and that would mean like fingerprints, iris scans. I don't know how much y'all are dealing in sending out iris scan information, but if you happen to, please remember to encrypt it. You've got DNA and signatures. So remember, if you're sending anything that the client has signed, that is their personal signature. It can identify them. It can be used by cyber criminals to sign off on forms to get money sent out. So that's something to keep in mind as well, signatures. All right, so that's some examples of PII. Some of them I'm sure you knew, maybe one or two might be new information for you, but this would all fall under that umbrella. This would all prompt you to need to secure that email. So a good follow-up question might be, well, how do I secure that email, CJ? Well, I'm glad you asked. Pretty simple. All you need to do, and you can see right here at the bottom, you just have to include any of these encryption trigger words in the subject line. You can use secure, you can use encrypt, and you can use sensitive. If you use sensitive, that one is a little special. if you send something using sensitive, that will force the recipient of your email to create a smart login before they can access it. So it's a little step further in the encryption process. If you're sending secure, if you're sending encrypt, it gets TLS encrypted on the smart server. But if you're sending sensitive, that takes it one step further to where the client actually needs to create a login to access whatever it was that you sent to them. So it's a little extra padding. If you wanted just to be sure that it's extra super secure, you can use sensitive to accomplish that. And, you know, I mentioned this in October, I'll mention it again. You know, if you're sending something out and you're wondering, you know, could this be considered PII? Well, if you're wondering, then I would just go ahead and secure that sucker, because why not just err on the side of caution? When in doubt, err on the side of caution. That would be my best advice to you guys. And best practices was another suggestion down here. Add encryption to all outgoing emails. I've talked about this a couple of times, and believe it or not, although that sounds like a super pain in the rear, there are a couple of offices in our branch that operate under this assumption that everything is encrypted. We'll just throw that in every single subject line of every email we send. So people do it, and it would protect you. I will be the first to fess up. Listen, I have sent an email. Okay, you know, is this being recorded? Maybe I shouldn't confess this after all. Okay, maybe hypothetically, once or twice, I might have forgotten to put encrypt in the subject line when I sent something secure. Hypothetically, that may have happened in the past. So I may hypothetically understand that this happened. However, if you're throwing that in the subject line for every single email, that kind of covers the whole I forgot. It also covers the whole I'm not really sure if it's PII. So it covers you in both places. I have a question. Let me just read this off the chat. Heard secure and encrypt only allow you to send emails one way to the recipient, and sensitive allows the recipient to reply in attached docs. Can I confirm? Actually, this is a great question, because something I have not yet covered, but I was planning to, is that this whole secure encrypt applies not just when you are sending PII, but it also is applicable if you are requesting PII from a client. So if you are requesting any of this information, you will need to encrypt. But what I can confirm is that secure and encrypt, and I will double check, triple check, and quadruple check. I'll reach out to 4 people at Cambridge just to make sure we have the right answer here. But my understanding is that any of these will allow you to encrypt both ways. So if you say, Mr. Client, please send me your existing brokerage account statement so I can review, and you put secure in that subject line, when your client sends it back, that should secure it using the secure that you initiated. Now, it's important to note that the client cannot initiate the security himself. So if you say, you know, Mr. Client, please send me a statement, and if you're going to send it to me, you know, you can send it to me by fax, you can mail it to me, but if you're going to send it back to me in an email, just put secure in that subject line. Doesn't work like that. The client cannot initiate the secure email, but you can, and then when you send it off to them, they'll be drawn into that secure email. That TLS encryption should stay on the email so that when they send something back to you, it stays on that encrypted TLS server. That is my understanding. But like I said, for the recording notes that I will send out this evening, I will reach out to Cambridge just to confirm that I don't have anything wrong. I don't have anything twisted. It's happened in the past, hypothetically. It's happened in the past, hypothetically, that I've gotten it twisted. So I'll reach out to Cambridge just to be sure. But my understanding is that if you initiate that secure email by putting one of these trigger words in the subject line, then that will encrypt the entire email chain back and forth, back and forth, back and forth. One thing I do want to talk about briefly on this subject, and this is something where I've seen before, where it resulted in a violation. Watch that subject line. Sometimes the client will change it and it takes secure off. And that is no longer a secure email chain and no longer going through the smart TLS encrypted server. So if you send something to the client, sometimes they'll change the subject line for whatever reason, Lord knows, but I've seen it before. Make sure you keep an eye on that. Make sure secure stays in that subject line if you're going to continue sending back and forth with the client. This covers not just attachments, but in the body of the email. So even if you have, you've written the very first email and it's in the body, that counts. If it's sent as an attachment, that counts. So just keep that in mind. It can be something written in the text of that email. It can be something attached as a file to that email. It covers everything. So if you are sending or requesting any of these items, either as an attachment or within the body of the email, please be sure to encrypt it using one of these methods. If the client sends you an email and it has in the body of their email some PII, make sure when you reply, you put secure in that line. The onus is on you guys to make sure secure is in that subject line anytime anything contained in that email is going to count as PII. So just keep your eyeball on the subject line, make sure secure is in there when it applies, and then be aware that it may apply even when you do not realize it, because these are items, like I said, except maybe the iris scan and the DNA, not so sure about those, but these are items that you guys are going to be sending back and forth pretty frequently, and any single one of them would trigger the need for an encrypted email. Okay, so pop quiz time. All right, what are we going to do here? What are we going to do? Okay, wholesaler at wholesaler.com. Proposal request. Hi, Mr. and or Mrs. Wholesaler. Gosh, I need a proposal for client with date of birth, Valentine's Day, 1986. That's a good year. All right. Do you need to encrypt this email? No one's chatting. Okay, fine. Well, I'll tell you this. Yes, I got one. Someone says, yes, excellent. Maybe. This is a tricky one. So it depends. Date of birth absolutely is PII, but it depends on, did I write client or did I actually write Sandra Smith? If I just wrote, I have a client, date of birth 2/14/86, can you give me a proposal? Not necessarily something you need to encrypt, because what makes it PII is that you have that associated with the client's name. Date of birth could apply to anybody. So if you were just requesting something and your wholesaler sends back a proposal that says, for valued client, date of birth, whatever, you're good to go. I tricked you guys. All right. Now, say I don't put in a name. I need a proposal for a client with date of birth, blah, blah, blah. However, I put in the subject line, Sandra Smith. I see this a lot, you guys. I don't know if this is how you catalog the emails you send about certain clients, but you will put their name as the subject line. Well, now you have triggered the need for encryption because you have the client's name and the date of birth. Also keep in mind, since you guys are so fond of using client names as subject lines, that immediately triggers any PII in the body of this email as needing encryption because you have that name paired with that information. So the important thing to remember is that the name does kind of trigger it. So you keep that in mind. However, when in doubt, just encrypt it. Just encrypt it. Now, this is all stuff we've covered before. I do want to cover something we haven't talked about, and this relates to the incident that we had recently that prompted this super fun refresher course on PII and encrypted email. So what has happened is actually, and in this case, both cases, the rep advisors or financial professionals, gosh, I gotta get used to that, financial professionals sent out PII and they secured the email properly. So far, so good, right? So what's the problem? The problem was they actually sent the email to the wrong recipient. And I mean, this is so easy to do. I have done it myself, not with PII, but with just something that I wanted to send out. And especially if you use Outlook, right? You just feel like, oh, I'm going to send this off to Craig. And then you deal with Craig all the time. So it's usually the top one on the list when you just type the first letter, Outlook pops up this handy list of common recipients, and you're like, okay, I remember he's the first one. You hit like C, and then you click the top one because that's where Craig always is. Well, maybe I've been talking to Christy a little more often than I've been talking to Craig lately, and now all of a sudden I just pick the drop down automatically and it's going to Christy, and I don't even notice it because for me it's just instinct. I hit C and I click the top one. It's streamlined, efficient process. Well, it can sometimes bite you in the rear. So maybe it goes to the wrong recipient. That's something that has happened. So please keep an eye, not just on the subject line for encrypt, but also on the to line to make sure that it's going to the correct person. If for any reason it does happen to go to the wrong recipient, what do you do? Of course, you contact your OSJ immediately, and we will work you through the process of working with compliance just to make sure that we cover our bases in responding to it, maybe offering LifeLock, all those fun, fancy things. So if it does happen, it's not the end of the world, but make sure you reach out to us, let us know, and we can help you with the process of figuring out how to tackle it. Another thing that you may want to consider is that it kind of covers not just having to worry about sending securely, sending encrypted, sending to the correct person, but now that we have ClickAdvisor as part of our subscription through Cambridge Click, you can use ClickAdvisor. There's a secure document vault in there. So if you want to send documents back and forth securely, instead of doing it through email, which you might run into the issues of forgetting to encrypt it or sending it to the wrong person, you can always just use that as an option as well. It's an alternative that you have at this point because we have that Click Vault as part of your subscription with Cambridge. So that might be another option for you guys. All right, I have a question. What if I ask for client statement in email, a client sends me a statement, but not as a reply to the email, but not as a reply to the email. They send it to you directly. I've seen this, and that is perfectly fine. If an email comes in from the client, and we can see in Smarsh whether it's inbound or outbound or what the deal is. So if we can see that it was an inbound email from the client and they just sent you something that was PII, and there is nothing under the body of the email, from you that says, hey, send me this, we can see that, and it would not be marked as a violation. So if the client just decides on their own to send you something directly, not as a reply to any email rather that you have sent, we can see it, and it's not a violation. So you're good to go there.
Arnie, this is Greg. I'd just like to add on that. You need to make sure that you explain in your email to the client when you're asking for the statement that they need to reply and send it in this email thread only, because they may not understand. When you say send me a statement, they may say, okay, they open a new communication with you and send you that. They may not understand that they need to keep it in that same thread. So make sure that you come up with some sort of language that makes it very clear that they do need to reply to this particular email and send it in this particular email. That way you're covered because you've disclosed to them, hey, you need to send it, back to this.
That's a great point, Greg. Thank you so much. That's brilliant. I'm sure I knew that, but it wasn't on the tip of my tongue. So thank you so much for sharing. That's really great advice.
And while I'm talking, I just want to cover a couple of things. I don't know if you're going to jump into this, but I just want to say it, make sure it gets out there. Cambridge used to cover spelling errors. So if you spelled secure, encrypt, or sensitive wrong, it would still catch it. They don't have that anymore. So you do want to make sure you spell those correctly. And back in the day, for sure, they used to have other emails. So you used to be able to get different types of emails, and it was a cost thing. So you could get an email that didn't have encryption included with it. Those are the Cambridge resource. So if you have an @Cambridge secure email like Catherine and I both do, then you're fine. But if you have like an @Cambridge resource, you may not have encryption. So you can contact myself, you can contact Cambridge Compliance Communications, or you can just send a test email like Catherine showed everyone how to send a secure email. Just send one to yourself and then look at the very, very bottom of that email and make sure it says that it was encrypted. That also applies if you have your own personal email. So if you're not at Cambridge, you're at yourfirm.com, those may or may not have encryption. So to test it, again, just send yourself an email. Look at the bottom of that email when you get it and see if it says that it was sent securely or encrypted. If it's not, reach out to one of us and we'll fix that for you. When you send that email, you also should get an email in your inbox saying that it was sent encrypted or secured. So just a couple of extra things I'm sure she was going to cover, but I just want to make sure that those are out there. Thanks, Catherine.
Yeah, you're absolutely right, Greg. I was definitely, totally, 100% going to cover those things. But thanks for allowing me a break. I could get a drink of water, take a sip of tea. Appreciate that.
For sure.
And Arnie, control your clients. Yes, you can. You can do it. I believe in you. Use shop callers if you have to. But no, we will be able to see in Smart that those are inbound. So, I mean, Greg's point, absolutely best practices. Let them know that it will not be secure unless they reply to your email. But if they send it to you, we will see it in Smarsh and we will not mark it as a violation. You are good to go. But consider the shop callers. All right. Well, I have used up a lot of your time. I don't see any more questions in chat right now, but if you have any, feel free to reach out to your OSJ. As always, we are here to answer any questions that you might have. I do not want to steal any more time away from our guest speaker. As I mentioned earlier in the call, we have Mac Winchester here with us to talk about some fixed income opportunities for you folks. So I will go ahead and turn things right on over to him. Thanks, everybody. All right. I see you speaking, Mac, but we can't hear you.
How about now?
Oh, yeah, we gotcha.
There we go. Sorry about that. Share my screen. All right, bear with me, everybody. Okay. You guys have my screen now too?
Gotcha.
All right, perfect. Sorry about that. All right, morning, everybody. Thank you so much for tuning in to my portion of the call here. I got to say, I like CJ's idea of shop collars, so I think that that is the best mode of motivating client action. I have a 12-week-old puppy, a 10-month-old baby, and a 2-year-old baby, so I might take a play from that playbook. I am the regional rep based in Orange County, California, from Lord Abbott. When Larry asked me to speak today, though, I was very excited. I didn't recognize the whole breadth of the firm and that some of you are in Pennsylvania. So for those of you who are, I put my blue and white on today, and I'm representing Penn State. So I've been having some laughs with some folks on the call here already. I played hockey there. My wife played lacrosse there. We graduated a while ago, and then wholesaling brought me out to Orange County, but I am a Pennsylvania native. So what I'm going to go through today, just a brief commercial on Lord Abbott for those of you that may not be familiar with the firm. Then I'm going to go through our take on what's happened in fixed income markets this year, how to think about what the Fed is doing, their involvement both from a support and a purchasing standpoint, talk about the market as a whole, and where we think positioning for clients is going to be strong. And then I am going to do a short equity commercial at the end as well. So for those of you that don't know Lord Abbott, we are one of the last privately held US-based asset managers founded in 1929. Just over 200 billion in assets. And if there's one thing you're going to remember about the firm, or that I would love for you to remember, it's consistency. And if you take a look at our investment lineup across the board, you're going to see just unparalleled consistency industry-wide. And I think a lot of that is reflected in how we're ranked against our peers. And you can see here on this visual, #1 tax-exempt muni team from Barron's for 2019. #5 in taxable fixed income, #5 for multi-asset, But I think to my point about consistency, we've been in the top 5 taxable fixed income fund families 7 of the last 9 years, and we're very proud of that. And our investment lineup certainly has earned it. So today, like I said, focus on the Fed, focus on the liquidity crunch in the bond market, and then kind of getting into positioning ideas from there. So
yes, I'm gonna need.
I've spoken to clients, end clients and their advisors about this, a million times since March. I know I didn't say this at the onset of the call, but I am locked in my garage working full time, sheltered in place. So I've had nothing to do but wonk out on fixed income markets with folks. And I've made the comparison to the bond market getting in an accident in the month of March. And what I mean by that is you saw liquidity evaporate, you saw trading cease, and you saw credit spreads, or the yield that you're paid in excess of treasuries, widen to levels that we have not seen in such a short period of time. And this visual here is showing you all these different sectors of fixed income on the left, and on the right-hand side where their spread, or the yield you're paid over treasuries, sat on February the 20th, where it got to by March the 27th, and the percentage wider that they were over that period of time. And you can see, I mean, almost 1,000% wider in asset-backed securities, but north of 100% in almost everywhere that you look in fixed income. If you zoom in on 2 areas, if you look at high yield corporates and you look at investment grade corporates, this is kind of a mind-blowing stat, but 5 of the single largest day moves in spreads occurred in the month of March. And we showed them here on this visual, but you can see if you look out at other periods of time where you had these big single day moves wider in credit spreads, the performance 12 months out for high yield bonds was about 35%. The same story holds true for investment grade corporate bonds. 7 of the single largest daily moves in spreads wider occurred in the month of March. But 12 months out, your performance was about 12.5% for clients that are rewarded for taking advantage of opportunities in the fixed income market. The last area from a spread standpoint to take a look at are the cash markets. And that's kind of where the whole issue in fixed income had started. But you see here, if you zoom in, you're looking at corporate notes versus T-bills. You're looking at commercial paper in the middle versus T-bills, and then asset-backed securities, AAA, versus T-bills. And you can see that jagged move wider over 2020. I mean, things that were yielding less than 1% in the commercial paper market were coming out yielding north of 8% that we were buying in some of our more risky funds. Because of the yield and because of the lack of liquidity in the market. But you can see on the right-hand side of this visual, the default experience for those parts of the market is basically null and void, right? You're looking at, less than 0.1% across the ultra short parts of the bond market. And so if you take all that in mind, and obviously the default question has come into the conversation, and I'll speak much more in depth about that in credit in a minute. But I wanted to show you all the dotted lines where spreads were, right, over the passage of time. And then the bottom lines that barely make it over 1% are the actual default experiences for clients in BBB, single A, double A, and AAA corporate bonds. So you can see that the market often prices in a much, much worse scenario than what is experienced for investors. And so when you look at all that illiquidity, the bond market got into an accident, the Fed shows up as the EMT, and they're doing triage work to get things back to where they were from a liquidity standpoint right away. And so what they did was they brought some plays back from the financial crisis that they had. And so that's the primary corporate credit facility, the secondary credit facility, and TAL for the term asset-backed facility. And that's roughly $850 billion in support for the fixed income markets. But they added some new tricks to some of these programs with the ability to buy corporate bonds, to buy ETFs, to buy CMBS and other sorts of asset-backed securities that they weren't doing in the financial crisis. So they basically revamped some of the programs for the current liquidity crisis that we're experiencing now. And they did it, I mean, with a speed that, you know, is unparalleled, truthfully. It took about 6 months to get everything off the ground in the financial crisis. It took like 20 days to get things operating right now. The other side of that equation and support comes more for the consumer and for the businesses from the fiscal side of the equation. But if you add up all the support for households, for public health, small businesses, airports, and specific industries, I mean, you're looking at, you know, almost $2 trillion in direct liquidity that's available now, with the Fed able to leverage their balance sheet and provide more. And obviously the ongoing talk of more support for the US economy on the fiscal side of the equation. So we think in that environment, it is a tremendous opportunity to position investors that need income, that are moving into retirement, that need to participate and defend in markets with the Fed at your back. And so, like I mentioned, the other part of concern or conversation that we have is about defaults. And so what I wanted to do was zoom in on credit, right? Zoom in on high yield. And so this is just another way to look at high yield spreads. But if you look at the right-hand side of the slide and those two gray boxes, you see that on March 23rd, so the low for the S&P 500, high yield corporate bond spreads were 1,000 basis points over treasuries. They're now down around 625. So they've come in, but they're basically pricing in a recessionary range. And that's exactly what we're experiencing. So you've seen a strong snapback. You've seen the Fed active in the market. But, you know, it's definitely still an environment where spreads are wider, and you can take advantage of that for long-term investors. And so I know this is a busy visual, but I'll walk through it. We wanted to take a look at when spreads came in over, you know, in under 800 basis points, what the performance was for high yield compared to the S&P 500 over certain time frames. So on the left-hand side of the visual, you have those 6 time periods where spreads came in, the initial month where they came in under 800 basis points, and what the 1-year, 2-year, and 3-year performance was of high yield versus equities. And you can see in each one of those time frames, high yield has actually beaten the equity market. And so taking advantage of credit spreads when they're wider, especially if you have clients that you did a great job with getting them back in the market right after the sell-off in March, and they're looking to take some profits, to build in something that isn't as risky as stocks, but is more risky and can provide some return that still has some legs to it, we think credit and high yield is a great place to look. So when you talk about spread levels and you talk about defaults, I showed the high quality markets a couple slides ago, but we wanted to show investors what the market was thinking from an implied default rate and what actually was experienced in high yield. And so those dotted lines at the top are what the market prices in when you see spreads over certain levels. So at 1,000 basis points over treasuries, which is basically what we hit in the month of March, the market is pricing in that 50% of the high yield market is going to default. I mean, that's crazy to think about, right? $1.5 trillion market, 50% of it defaulting. But if you take a look at the bottom, we looked at bonds issued in 2000, we looked in 07, and then the whole average from 1920 to 2017. You can see in the first few years, defaults are incredibly low. And as you get further out, they do creep up because companies do go insolvent that don't survive. We see that in businesses everywhere. But it's just interesting to think about how much worse things are from what the market is pricing in versus what we experience. Another thing about the high yield market that many investors overlook is the fact that the market has come up in quality a lot. And so what you're looking at here, those 2 boxes or 2 bars that I put a green highlight around, you're looking at the percent of B rated high yield bonds versus double B in the year 2000 in gold and in 2020. So you can see that they've almost flip-flopped, right? Roughly 55% of the high yield market today is rated double B, and it was opposite, more risky and B rated in the early 2000s. The other headline that grabs a lot of our attention is the fallen angels. And with the Fed actively providing a backstop to many of those companies, we think it's an awesome opportunity to have as a portion of an allocation. Definitely not something to do blindly via an ETF or something like that. But you see here on the right side, year-to-date fallen angels has already exceeded that of the financial crisis and that of the tech wreck. But fallen angels can be an incredible opportunity. And so you're looking at the time from trading days post when credit spreads hit their cycle wides, and you're looking at the performance difference of fallen angels versus double Bs. And so you can see here, like in many cases, if you have a great active manager behind you that's navigating credit markets, they can take advantage of these fallen angels. And in a lot of cases here, you know, deliver double-digit returns as part of a diversified portfolio. But it's definitely not something you want to do blindly. And so we took a look at 4 companies here: Apache, Occidental Petroleum, Macy's, and Continental Resources. So obviously we all know Macy's, and Occidental is obviously in the news every day, but Apache and Continental are also energy, natural gas, resource-oriented companies. And you can see the price of these securities when everything was pretty normal until liquidity evaporated in fixed income. You can see the cliff that they all fell off of when they were downgraded. And then you see a very, very choppy trading experience in all 4 of those bonds since then. And so you can have a performance experience for clients that is very, very different from one fallen angel to another, which makes the case for active management. So pivoting to the actionable areas, this slide, though simple, is what scares me the most for fixed income investors on the left-hand side. And so you're looking at the yield versus the duration of the ag in teal. The ag, which is obviously the largest allocated part of the taxable fixed income market in the United States via core bonds, core plus bonds, ETFs. I mean, it's, you know, a $25 trillion enterprise, is trading at all-time highs in price with a yield that on this slide is 2.4%, but it's lower than that now, and a duration that is longer than it's ever been almost. And so though we don't think rates are going higher from here, the market controls intermediate rates. The Fed controls the short end of the curve. I think that there's more risk in owning too much duration and too much high quality fixed income. And we think that the best risk adjusted area is short-term credit, where you keep it, you know, A-rated or better, but a duration less than 2 years, and diversified in corporates, commercial mortgage-backed securities and asset-backed securities. But we just don't like the bond math in that part of the market, and that's what scares me. So if you think back to a couple slides ago, I showed all these sectors and where spread widening had happened, and how we have the Fed supporting us in the market and how to take advantage of that. And so one way to do that within the Lord Abbett franchise is Lord Abbett Bond Debenture. That's LBDFX, LBDFX. That is my one half of my Don't Fight the Fed trade in fixed income. And so you can see Bond Debenture is our oldest multi-sector bond fund. It's comprised of investment grade corporates, high yield, non-US investment grade, equity, which is usually converts that we hold in the portfolio, but a very, very diversified portfolio that is taking advantage of all this spread compression in all these sectors of the market and the Fed backstopping us. It's one of my favorite funds to talk about to clients because it's been around for 49 years. Of those 49 years, 40 of them have been positive in performance, and 19 have been double digit, which are those boxes in green on the top. And I wanted to show you guys what this looked like compared to the S&P 500 during those down years. So you can see on the bottom of the chart, those 9 down years, where Bond Debenture was compared to the S&P 500. So it saved money on the downside. And then looking at the following 12 months out, outperforming on the upside. So Bond Debenture can provide equity-esque returns with a lower risk profile. And the reason I think it's timely today, outside of spread compression and what's going on in fixed income markets, is just taking a look at where it's priced. So you're looking at the 10-year NAV of bond debenture, and you can see when it gets to those low points, it usually rallies back strong for clients. And we've made up a lot of the distance since March, but we're not all the way back up yet. And so I zoomed in this year, and you can see the high at 828, and I put a line to where the Fed started purchasing in fixed income markets and the nearly 6.5% rally that we've had since then. And what we would think is legs to the upside with the Fed behind what we're doing. This is bond debenture versus some of the big competitors that I come across in my territory. For those of you who know Orange County well, you'll know that I actually stare at PIMCO's home office from my house. But this is over the last, since the market low on March 23rd, how bond debenture performed compared to a lot of its peers. And then this is stretching it out over 3 years. So you can see it's the second largest fund in the multi-sector bond category for a reason. It's consistent, it's been around forever, and the process has been the same. The other side of my don't fight the Fed trade is Lord Abbett short duration income, which I know many of you on this line know. It's our 2-year duration, A+ credit quality, 3.20 yield on the fee-based share class. It's outperformed the category 99% of the time over rolling 3-year periods, which you see here. It provides that good bond math with a duration of 2 years compared to that of the ag around 6 years with higher income. And again, speaking to Lord Abbett's DNA as a multi-sector manager, these are the areas that we can invest in, but it's primarily going to be built of investment-grade corporate bonds, commercial mortgage-backed securities, and asset-backed securities. This is probably one of my favorite charts to show about the fund, but it's on the top, you're looking at periods when rates and spreads either rose or compressed. So red is when rates were going up and spreads were widening. Green is when yields were coming down and spreads were compressing. And on the bottom, you're looking at the fund's consistency in each one of those years compared to its peer group. And so what I wanted to put together, and I think Larry will put this out in follow-up, is a 50-50 blend of bond debenture and short duration. That's compared to the ag. So you can see it averages almost 5% a year in total return. The cumulative return over that time frame, 62%. From a calendar year standpoint, it's only had one calendar year time frame where it was negative, and that was in 2018, where short duration was positive, but offset by some negative performance in credit areas that bond debenture invests in. But I think what's telling about this for a long-term client is that on a rolling 36-month time frame, this portfolio has never been negative. And I think that if you want something that allows clients to generate income, take advantage of the opportunities in fixed income markets today, there's nothing better than entrusting those dollars to Lord Abbett, whether it be bond debenture by itself, short duration by itself, or some combination thereof, depending on the client goals. The second portion of what I had, I just wanted to go through quickly, is to share some equity insight. Obviously, the equity market has been a tremendous thing to watch and invest in and put money to work in for clients this year. But I wanted to show you all the factor-based performance in the month of March, which is what you're looking at in the middle here. So you can see momentum, growth, and quality all protected clients more than the traditional downside sectors of the market like value. So we think that innovation and growth type parts of the market are actually now more defensive than, you know, the value trade of yesteryear. If you look at where we are now, this is as of May 29th, those sectors are leading the charge on the way out as well. So growth and quality especially, they're positive year to date. And so in our mind, indices are comprised of yesterday's winners, right? You're looking at the top 20 holdings in the Russell 1000 growth here. Many of them are paying a dividend. Many of them have, you know, low to negative sales growth in some cases, and they find their way into a lot of active large growth funds. They're, you know, branded beta and the growth ETFs because of their valuations. But we don't think those are the innovators. We don't think that that is a vehicle to accumulate wealth for clients from here. And so we define companies that are innovative, that are high growth, that are those that are investing the most in R&D, which you see on the top. But most importantly, we're looking for companies that are in the highest 10% of revenue growers. And even though they carry a higher PE, they have earnings growth. That's what's going to grow us out of this recession. And those companies that are generating earnings growth are delivering higher annualized returns as well. A lot of those areas of the market are focused on innovation, changing what we do. I mean, this crisis has brought about massive changes in habits at a pace never seen before. But our sector picks are in technology. You can see them listed here, in biotech, pharmaceuticals, and healthcare, which are all listed below. And then the kind of empowerment of consumer or consumer discretionary parts of the market. An example I'll use with you all is online grocery shopping. Like I said, we have 2 little kids and a puppy. We've been locked in our house for 4 months now. We had never grocery shopped online prior to this crisis. And now we use Instacart, and I don't think that we'll actually go back to the grocery store for our full grocery shops ever, because it's so easy. The habits changed. Or just look at what we're doing right now on Zoom. Like, these calls never would have happened. So Lord Abbett Growth Leaders is our large cap growth fund, ticker's LGLFX. They're the top 5 overweights versus underweights compared to the Russell 1000 growth. And then on the bottom, you're looking at where we are from a trailing 12-month revenue growth standpoint compared to the Russell 1000 and the S&P 500. So we're looking at companies that are delivering revenue growth almost double that of the major indices that you could compare us against. One of the best strategies on the street, you know, top decile across the board. But again, looking at it compared to some of the largest peers that I see in my territory, strong outperformance over 3-year, strong outperformance over year to date, making the case that focusing on high growth and focusing on innovation and disruptive type stocks can lead the charge out of a recession. That was all I had. You know, if y'all have any questions, I'm here to be a resource for you. But thank you for your time. Thank you for your attention. You know, always here to help you out. And so in follow-up, what you'll see, if Larry hasn't sent it out, the email with some of the content that I went through today. He'll also provide a wholesaler map, which I will send over to him. But if you have any questions, my email is mwinchester, WINCHESTER, @lordabbott.com. So I'd like to open it up for questions if that's okay, but thank you so much for having me on today.
We had one question from Arnie, and he was hoping you could help us understand fallen angels a little bit more.
Yep. So fallen angels are those companies that go from BBB rating, which is the lowest rung of investment grade or high quality bonds, to high yield. So they fall out of investment grade into the high yield index.
Perfect. Thank you so much, Mac. Any other questions? I don't see any more in chat. I'll give people a moment or two to speak up. All righty. Well, thank you so much, Mac. We really appreciate it. We've spent a little bit of time on our calls over the past few weeks discussing some of the investment opportunities post-COVID, but this is the first chance we have really had to discuss those opportunities in the fixed income space. So we really appreciate you taking the time to join us today and share Lord Abbott's insight on that space in this current environment. Thank you again for joining us.
Of course, thank you.
And of course, we will be including his contact information, wholesaler map, and some pieces for you to reference in the recording notes. And one more question from Arnie. How do we find notice fallen angels?
Yeah, so the Federal Reserve website will track that. You know, you could certainly come to us, and we're taking advantage of that. But if you look at if you Google search the St. Louis, type in St. Louis Fed, and then the name Fred, it'll bring you to the St. Louis Fed's database. And if you just type in fallen angels, it should provide you that list right there. If not, just ping me and I can get you the information on an ongoing basis.
Perfect. Thanks again. And thanks everybody for joining us. I do just want to circle back. I noticed that Ursula had put a question in chat that I overlooked. My apologies. This is considered correspondence if we send something to the client via Vault, right? And I am not 100% on this, so I'm going to check with Cambridge. My understanding at one point in time was that because it is captured there, it is considered monitored and you might not need to submit it via correspondence, but I want to reach out to Cambridge just to be sure. That will be one of the 2 Cambridge items that I will follow up on in the call recording notes this evening. And thanks everybody for staying on. I know it's been a little bit of a long call, but I think it was valuable, not just Mac's piece, but hopefully mine as well. And, you know, I know we like to have fun on these calls, but I do just want to stress, you know, that the encryption, it really is serious, guys. A major or even just a minor data breach can turn into a major fiasco for you guys. So just stay hyper vigilant. I could not stress enough the importance of making sure you are encrypting and protecting your client's information. So I'm going to end on that serious note. I can be serious from time to time if I'm pressed to do so. But I want to thank all of you for joining us. Larry will be back in control next week, so you don't have to listen to me. And I am glad that you joined us today, spent a little bit of time with us as always. Look forward to hearing from you all and seeing all of your faces next week. Until that time, enjoy the rest of your day and week. Talk to you then.